It is the end of the year and the market seems to be ending in negative terrain. The bears out to play. Is there anything that could lift this market at this stage?
Well, between now and the year end, I doubt it. I think that the market is what it is. It's been a very difficult year, not just in Nigeria, not just in sub-Saharan Africa, but globally. And the issues that made it so are still very much lingering. We still have that Eurozone overhang that doesn't seem to be able to be quickly resolved just because of the setup there. They have a number of nations that need to come to agreement, and these things take time. So, that's something that will keep rumbling on into the first quarter of next year. And then the growth outlook for other countries, the US, is still relatively soft. And China is also looking at trying to sort of slow things down. And so the general outlook is not particularly rosy.
Right. I mean, Wally's just been having a conversation about the banks because we know that they're the largest constituency on Nigeria's all-share index, and apparently they're down 40% this year. So in terms of recovery in early 2012, are you hopeful?
Well, I mean, the good thing about the banks actually is if we take a step back and look at the fundamentals, they have improved significantly over the last year. There's no doubt about that. There's definitely more clarity in the sector. There's more robust balance sheets. Balance sheets are more robust, and I think with name selection, from a fundamental point of view, investors can certainly position themselves well in good names for the sort of medium to longer term. The challenge really is that given where the fixed income yields are and at the short end of the market, the kind of returns that investors can get, even the fact that we have dividend yields that are double digit are very difficult to compel investors at this stage, and that's the challenge that we face. But if you're a long-term player, you're not going to necessarily put every last naira or cent that you have in the short end of the fixed income market. So, if you're going to put some in the equity space, there are some good quality names that are trading at very attractive multiples and that also offer good dividend yields as a sort of a halfway house between the fixed income yields and the sort of pure equity play.
I mean, we're almost at the end, or in the long haul rather, of the last haul of the mergers and acquisition for the banks. And I know on December 31st it is that CBN guarantees are removed for some of these banks. So it raises the question of just their financial sanctity and their ability to operate independently, liquidity.
Yes, well, I mean, I think that, to be honest, I don't think that that's an overbearing concern. The fact is that these banks are effectively nationalized. They are owned by AMCON. They have a significant amount of AMCON bonds that can be discounted for liquidity if they need it. And I think that, their balance sheets have been repaired. Their capital adequacy ratios are, around about 15%, which is acceptable. So I think the issue with those banks is more about their sort of medium-term competitiveness. The AMCON indicated that they wanted to sell those banks in 3 years at the latest. And in order to sort of build value there, they're going to have to turn those banks around operationally and really kind of begin to make their presence felt from a customer point of view in order to make that possible. So it's not so much a liquidity concern in my view.
The sorts of things that we're going to see Nigerian banks doing in year 2012, we know that at times they have to work in tandem with the broader national agenda, and we've seen 30 billion naira being allocated for credit financing of agriculture, for instance. That's going to happen with some of the tier 1 banks. The kind of role the banks are going to play in infrastructure, where people are not, or where the state is not going to go to the market for financing some of its infrastructure concerns. Are they going to come into the banking sector, and are we going to see the banks feeling the pressure in terms of crowding out of government borrowing versus real economy borrowing?
Well, I think as far as broadening the base and broadening the sort of, or increasing the interface between the banks and the real economy, that is, again, not a quick fix. It's not a silver bullet situation. I think that the good thing is that over the last 2 to 3 years, there's been a lot of work done and that remains ongoing that is seeking to actually genuinely broaden broaden that interface. And I think that, de-risking the agricultural sector doesn't happen, overnight, but the work is clearly ongoing. I think we have a very vigorous, energetic and committed Minister for Agriculture that will certainly drive through some changes. The same with respect to power. There's progress that is taking place in that regard. But as with anything public sector in any part of the world, never mind in a frontier market, it always takes longer than you'd like it to take. But the direction is clear, and I think that the momentum is there. In 2012, the expectation is that we will see some privatizations, and banks are supporting those that are looking to take these assets private. It's a matter of checking the viability and making sure the numbers stack up, but I don't think it's a case of the willingness not being there. I think that as far as power, infrastructure and agriculture is concerned, I think that 2013 we'll see it being more visible on bank balance sheets than will be the case in 2012, but the momentum continues to build for sure.